What is up, YouTube? Today we're talking about what market bubbles are, how they're formed, what you should look out for in regards to what a market bubble is. And the reason why we're making this video is if you've seen a video like this pop up on your suggested page by Graham Stephan talking about the used car market or car market bubble, or even pretty much every finance YouTuber has made a video about the used car market bubble. And if you're familiar with the 2008 crash, you know that it's because of a real estate bubble. So today we're going to talk about market bubbles and why they're so important. Before we get into that, please leave a like on the video, hit that subscribe button, hit that notification bell. It would mean the world to me, and your support is so greatly appreciated. Now, with that being said, let's get right into the video. So when you think of a bubble, you obviously think of the stuff that we used to blow as kids, just the little soap and water and... But that's not really what a market bubble is. It's the same concept, but basically a market bubble is just a way to express the fact that prices are way overinflated in a certain sector. So for example, like in 2008, the housing market crash was caused because of a housing bubble. Now, the reason why the bubble was formed was because so many loans being taken out to buy houses that people couldn't afford, which caused the housing prices to just explode exponentially. So meaning the houses were getting more expensive, people needed bigger loans to buy the houses. Houses were seen more as a commodity, and people were wanting to buy up more and more real estate because they were having better returns and whatnot. But the big problem is the banks realized, like, hey, people aren't paying. Foreclosures were on the rise, bankruptcies were on the rise. So banks started calling loans, which it is a complete legal right of the banks to call loans. And so what happened is all these people had millions and millions of dollars of debt because they're buying up real estate because they thought, hey, this is a great investment. Let's get in on it. Let's just see what we can do and see how much we can make. And so when banks started calling the loans, no one had money. So what happened is the bubble popped. And the reason why it popped is because banks were calling loans. And basically, this caused a mass dip in the market because people were putting foreclosures, people were selling their houses, and what was causing the spur on of the price increase and the bubble to form in the first place was there's too much demand and not enough houses. Because that is the baseline of what we're going to focus on today, is demand versus supply. Now, if you've taken any economics courses in your college career or just in high school or anything, you know supply and demand is a driving force of any economy. And especially the reason why some commodities and some consumable items are so popular is because there's such demand and there's not enough supply. So like microchips, for example, are a big thing right now where there's too much demand and not enough supply. So microchips are super expensive. So you're kind of seeing a miniature bubble there. However, the difference here is the microchip is very tangible, as in it's more expensive because the supplies that are going into the microchips are more expensive. Now the reason why the housing market was inflated in price wasn't because of the supplies were costing more. It was genuinely because there's too much demand and not enough houses. So when the banks called the loans, it caused the bubble to pop. So let me explain to you. So basically what happened is the banks, when they called the loans, everyone is putting their houses up for sales, as I stated earlier. And so now the demand, you could buy a house for pennies on the dollar, and now there's not enough demand and way too many houses, and it happened in a matter of a month or two. And so this really hard shift between not enough and then too much, that's what causes a bubble to pop, which caused the market collapse of 2008 because real estate was just being so loaned out because people were just taking out so much debt. And that's why you saw people foreclosing all over the place, and you saw people selling their houses, but there wasn't enough people buying the houses, so they had to go file bankruptcy, and it was just a whole circus and a whole mess. Now, I just explained how a bubble can burst and how it looks like. So for a historical example. Now, you're still probably sitting there like, what the heck is a bubble? Like, that didn't help me at all. So I know. So let me go into what a bubble is and kind of how it's formed. So when you think of the bubble that you used to blow as a kid, where you'd blow into it and just So when it's blowing and filling full of air, think of that as the demand. The demand is what's driving the price. So we're going to refer to the price as being the bubble. So the actual like soapy material substance that forms the bonds that forms the bubble. So the bubble is the price. That's the price. And demand is causing the bubble to expand. So when you're blowing into a product or blowing into a bubble, there's more and more air going in, causing the bubble to expand and expand and expand. Now, however, that the atmospheric pressure, so the outside forces on a bubble, cause the inside pressure and the outside pressure to equalize. So the bubble doesn't pop until something acts on it that causes it to burst. So when you're blowing a bubble, if you blow and blow and blow and blow and you don't stop blowing, it'll just pop because the demand overwhelms the price and it just opens up. The pressure on the outside can't hold back the bubble. Now, the opposite is if you underblow the bubble, it'll start building bubble and then it'll collapse on itself and pop. So that's an example of how, and as the outside in this example is just the pressure of all the like, for example, the inputs of a product, the MSRP of a product to return to a normative price. Now, what does it mean to be normative price? It means something that it's actually worth. So in Texas, you're seeing a massive, massive influx of people moving here, and it's causing certain areas to just have an astronomical explosion in the housing market, which is really just causing a bubble in those local markets. So for example, in Dallas, you're seeing houses that used to go for $500,000 now going for $1.5 million, which is a 3 times, the bubble. Now, there's so much demand for people to move into Dallas, but at the same time, there's not enough supply. But now you're seeing people are moving out of Dallas that are native Texans and moving elsewhere. They're moving to, Fort Worth, San Antonio, Houston. And so now there's more supply. There's more supply to meet the demand. So basically, now that you're seeing it's just causing a massive mess. That's just what I'm trying to say. So this miniature bubble is not being really resolved because Californians, when they're moving into Texas, they're used to houses being worth 1.2, 1.5. So when a native Texan goes to buy a house that they know is worth $500 or $500,000, and the Californian comes in and is like, we'll give you 1.5. The sellers obviously then go with the 1.5. But the Texan is mad and upset because that's what's causing them. So they're going out and possibly even building a new house or just living in an apartment or something. So it's that push from like the locals of a housing market to return to normative price. Or, for example, if you're producing a product like microchips, let's say silicone or copper. The price of copper and silicone falls. If it falls, it means the factory can get it cheaper, which means they can produce more for a lower amount of cost, which would want them, if there wasn't such a demand splurge for microchips, to lower the price so more demand comes on and pulls it. So that outside price, so the outside forces on a bubble is just to return to normative pricing, and that is because, for example, if demand is faltering, you have to kind of draw in the price to push back or to give back demand. And then, so it's just really just the demand curve. If you look at an economic graph, and I'll put one up here just so you can see what I'm talking about. And so the bubble, going back, I know this is very long-winded and I hope you're sticking through it and I hope you find it useful. So the bubble is formed when someone is blowing, or the economy is blowing demand, which causes the price point to expand and expand because the massive amount of demand that's being hit is causing the price to increase and increase because they can't get enough of it because they're used to there not being much demand for a certain product, but now there's a massive amount of demand. So they're trying to meet the demand, but to slow down demand, they increase the price, but demand isn't slowing down, so the bubble just gets bigger and bigger. And so there's this massive tension at the point of the price. And basically what that means is the tension is formed because if you think of a bubble as a wall, when you have a wall, it will go out and out and out and go and go and go. And it gets to a point to where it's at a breaking point. And once it gets to the breaking point, if something it pops. Now, however, So if the inward force of the bubble shifts in any direction, outward or inward, it will cause the bubble to pop at that point of hypertension, because the pressure on the outside of returning to normative price is there. So it's constantly there. It's constantly pushing on the bubble, causing it to be kind of squished against the demand and the demand to return to normative price. And so the price point is very, very flexible. It's very much so not in a solid state. It's susceptible to both the input of demand and then also the pressure to return to normative price. And if any one of those shift at all in any shape or direction, boom, it causes the bubble to pop and burst. And so, for example, when I was talking about the 2008 market crash, the thing that caused the bubble to pop was the lack of demand, because the banks decided to start calling loans. And so people realized, like, oh, I can't go buy a house because I can't get a loan because I know I can't pay it. And so the defaulter in demand caused the slightest bit of the inside pressure on the bubble to falter, which caused a little collapse, which caused the bubble to pop. And then the outside forces just overtook and slammed the prices of the housing down. Or so for the used car bubble that's occurring right now, you're seeing similar things. Is no one can get new cars, so there's so much demand for used cars because people still need cars. And if their car junks out, they're willing to spend an exorbitant amount of money on this used car just so they can get to work, they can get to the place that they need to, the hospital, whatever. And so that is causing a lot of demand to push the price point and push it and push it and push it to the point of, well, really to the breaking point. And what you're seeing in what people are talking about as the bubble of the used car market is in a pop, or it has popped, is because now that we're recovering from COVID and microchip places, microchip factories are opening back up and workers are getting back into the workroom, it's causing microchips to start being produced, which means that new cars aren't as inflated in price. The supply chain, although a complete wreck right now, they're starting to be able to produce new cars. So the demand is starting to shift from used cars to new cars again, which is kind of where it's always been. Is when you have less than, like $1 million, it's encouraged to go get a used car and never buy new. But now that people are, like, I'm tired of this car, they're going to get new cars because the microchips are available and they're starting to lower the price, which is causing the bubble to pop on used cars because the demand shifted. And because the demand shifted, it's causing the prices of used cars, and it will cause the prices of used cars to just plummet. So right now, you can probably take a car that's completely a beater car like this and take it in to the dealership and be like, hey, what can I get for it? And they'll give you $30,000, when in reality, it's probably worth $250. It's probably just useful for parts. It won't run, it won't do anything. So, but they're wanting to buy it because someone else will probably buy it either for parts or what else. Now, parts on used cars are stupid expensive because that's all people are buying is used cars. So, market bubbles, moral of the story, are super complicated, super complex, and there's a lot of different factors that go into a market bubble. And what you should look out for a bubble to be formed, and should possibly warn you, like, hey, maybe right now is not a good time to buy a house, is if you're looking at Zillow or some real estate marketer app, and you see that housing has a pretty consistent increase in price, and then all of a sudden you see a massive uptick. That's literally a proof of a bubble. If you see a massive increase in price just out of the blue, that's signs of a bubble. And that's literally what a bubble looks like on a graph. It's a consistent growth, and then a massive explosion, and then the bubble pops up here at the very high point of hypertension, and then it collapses. So you literally see on the economic curve, it looks like this. And I'll put a graph up of a market bubble so you can see it. And that's literally what a graphical representation of a market bubble looks like. And so if you're looking at housing prices in a certain area, Los Angeles, right now, Los Angeles is probably seeing the bubble popping. People are moving out of Los Angeles. There's not enough people moving in. So prices of real estate are collapsing in Los Angeles. And so if you look at the graph, Los Angeles became a very, very hot spot for the last 40 years. And so consistent growth, massive explosion because all the entertainment. And now people are realizing that they don't want to pay taxes. So all the wealthy people are moving out of California to, this is a really bad way of putting it, but of seeking tax asylum in other states. And so you're seeing all the high value properties just going up on the market, which caused the housing market in LA to collapse, which caused the bubble to pop, which caused the housing prices to decrease. And so you don't have to have a big economical bubble for you to be impacted. A bubble in a local area can be just as bad. If it's hard for you to get corn imported into your places of work, and let's say that you're producing a lot of corn-based products, there's going to be a bubble that's forming on the corn because the demand and the supply aren't matching each other. And then bubbles aren't a good thing. And it's usually, if you see a sign of a bubble, don't buy. And what you should actually do is wait for the prices not just to dip, but once you see they kind of edge out at the top, once you see that and you know that prices are just, not just, general prices. When you see the price, because let's go back to Dallas. Let's go back to the Dallas example. The standard middle class home in Dallas used to be anywhere between $250,000 to $400,000 to $500,000. Now, those same houses in a matter of 3 years have gone from $400,000 to $1.2 million. And so that massive explosion of price is sign of a bubble. Now, the price is probably going to be pretty steady up at that height, and so it's not a good time to invest in a property in Dallas right now because there's so much demand for people moving there. I like to think of the economy as a social experiment. As in, once something starts happening, the general trend is for that same action to occur over and over in a local facility or a local area. So if one person lists their house and decides, hey, I'm moving to Las Vegas, then their neighbor might be like, yeah, I like the reasoning for that. So they put up their house for sale and move to Las Vegas. Then the rest of the neighborhood's like, wait, why are they moving out? Oh, they're moving to Las Vegas because they're saving millions of dollars in taxes. Oh, then let's move to Las Vegas. So you'll see literally the bubble pop because one person took action and fled. Or not fled, just put their house up for sale and moved. That's how quick markets can shift and how bubbles can pop. And so if you're looking at an investment property, look at the last 10 years of the price. If it's a very consistent growth and the growth is consistently the same as it was 5 years ago, and the anticipated price of the real estate or whatever entity you're buying, if it's relatively accurate with the growth trend of the price of that commodity, then buy it. But if it doesn't fit, that it's massively inflated, then don't buy it. And so that's all you have to do is look at the last 10 years and just see how the price has grown. And if it's gone wonky, don't buy. But if you also see the fact that, okay, the price went really wonky here for the last 3-4 years, possibly even the last decade. But now all these houses are being put up for sale, and now the houses are falling back, and they're falling and falling and falling. And when bubbles pop, it happens in a matter of overcorrection. So think of it literally as when you blow a bubble. When you blow a bubble with your gum or whatever, if you're blowing a piece of gum and you're blowing a bubble, you'll blow and blow and blow until the forces on the inside makes it pop, but then the outside forces of the bubble will force it back to your lips. And it also can be because, gum has an elastic effect. The bonding between the molecules causes a spring-like effect, so it returns to your lips. Same thing when you're blowing a normal bubble. When you're blowing a soapy-like bubble, it blows, and when it pops, you might get some soap in your mouth. And that's because it has that elastic spring-like effect. And what happens, if you look at a spring and you stretch it out and you let go, it will overcorrect, it will slam against itself and then return to a normative, springiness. And that's literally what happens after a market bubble pops. You'll literally see that you can see it as, I'll do it in the spring analogy now. It stretches and stretches and stretches and stretches. The price keeps going up and going up and going up and going up. And then pop, it slams, the price falls back, overcorrects, and then it comes back to a normative price. And so when you see a bubble popping, that's one sign to buy, like just to know that it would be a good time to start buying in the next couple weeks, next couple months, and maybe in the next year. And so once the bubble pops, go for it. Go for the buy. But when you see a bubble starting to form, don't buy. Do not buy. It's a bad idea. So with that being said, I know market bubbles are very complex and very confusing, and that's why I wanted just to try my best at explaining it to you. Because when I was first learning about market bubbles, it literally took me days of reading and research just to figure out what the heck a market bubble is. So with that being said, I really do hope this video was helpful. I know it was complicated, but market bubbles are very complicated. And if you have any questions, please just leave a comment down below, reach out to me on Instagram, DM me, and just ask me your question and I'll try to give you the best answer. But here's the thing, I don't know everything. I don't. And so for me to pretend that I know everything is a falsity. So if you ask me a question I genuinely don't know, I'll give you the best way to find that answer, either through a government website or a better resource like Motley Fool or something. So with that being said, I hope you found today's video helpful. If you did, leave a like on the video. It would mean the world to me. Hit that subscribe button and hit that notification bell so you can be notified about any future upload. And if you want to get a stock worth up to $1,000, go click the link down below to join me on Public. You can get a stock worth up to $1,000 and follow me so you can see what I'm investing in. Now, with that being said, it is the Money Sausage signing out. See ya.